think we have Travis here with us now. Travis, what's going on, man?
How are we doing, sir?
Just pretty chill day here watching Bitcoin seem to fall out of the sky as people freak
Low
out.
key, little low key Monday here.
I mean, great timing for you and I to go ahead and decide that we were going to do this. Let's start maybe with like a little bit of just market structure in general. The last 2 years has been pretty incredible for Bitcoin. Obviously, start of 2020 was kind of around $8,000-$10,000, ran all the way up to 69,000 back in November. What's your general read on like maybe why some of that occurred and how much of it is like Bitcoin or crypto market stuff versus just, the Fed stepped in and was going to pump asset prices and Bitcoin's volatile, so it went up?
Yeah, if I was going to boil it down to one thing, I guess it would be like two sort of market adages. One is don't fight the Fed, and the other one is it's all one trade.
Okay.
And don't fight the Fed's been around for at least a decade, and it's all one trade's been around for the last 2 years. And basically what both of those kind of speak to is the same backdrop, which is central bank actions in the current monetary regime have such an overwhelmingly powerful impact on all asset prices that basically everything else is almost just an afterthought. And that was the backdrop for the run up after the COVID crash. And that's now, the backdrop heading the other direction as the Fed is trying to tighten monetary policy.
Yeah, I tend to agree that is a huge driver, if not the only thing really to pay attention to right here. What I want to do today is talk about Bitcoin, but I want to use it as kind of a discussion point for more of like the macro environment and a lot of the stuff that's going on there. If you subscribe to this idea of it is all one trade. Bitcoin to me seems like it's the most pure macro asset maybe, but it's still part of this kind of larger legacy financial market. And so you sent out a recent update. We've pulled a couple of the charts out of there that I thought just were home runs, frankly. And the first one, and I thought it was very telling that this was like the first thing that you led with, was the price of Bitcoin. And you overlaid a tweet on top of it. And the tweet says, the former New York Fed Governor Dudley, if stocks don't fall, the Fed needs to force them. And it was citing a CNBC interview. And that was back in kind of early April, which obviously was part of this like price relief rally after Bitcoin had dropped 50%. And so talk to me a little bit about this like mentality coming from the Fed, whether active officials or former officials, of like, they seem to think that they are in control and they know exactly what they're doing.
Yeah, so I think there's two things I'd speak to about that chart. The first one is just how tightly NASDAQ and Bitcoin are trading with each other. And you can just see that they're overlaid on top of one another, and they look like exactly the same. And then the second thing that I added was that tweet, which was basically a former Fed governor writing a Bloomberg op-ed article that was entitled like what it says in that tweet: if stocks don't fall, the Fed should force them to fall, which is a pretty crazy thing for these boomers to be running around saying. But they are dead set on fighting inflation. They're terrified of inflation. Inflation is, the hot button political item. The Fed has become deeply politicized. The notion of an independent Federal Reserve, I think, is a joke at this point. And so the Fed has a few different mechanisms that they think through trying to sort of tame inflation with, but one of them is through this mechanism called financial conditions. And there's an index you can type into TradingView or Bloomberg, the Financial Conditions Index, which is a combination of a few different things. But two of the inputs into financial conditions are equity prices and debt prices. Fixed income prices. And so one way to tighten financial conditions is to make stocks, the price of stocks fall, make the price of bonds fall. And by doing so, the Fed has this view that through sort of wealth effect, people's net worth is going down because they're long stocks, they're long bonds. The prices of those are going down. Their net worth is going down. As their net worth is going down, it makes them buy less things, spend less money, and then that has a an effect of taming inflation over time. And so that was really what Dudley was speaking to, and other Fed officials as well too. And so it gets you into this pretty, kind of creepy spot of, the Fed feeling like the best way for them to try and get inflation under control is to just hit everybody's net worth. And they can do that with, maximum jawboning. And then how much of that jawboning, so jawboning is just this term of like, talking a big game about something, and then how much of that talk actually translates into action then sort of remains to be seen, and is what's going to be front and center over the coming months.
So we've got a chart that you put in the update, which also has kind of the pricing of interest rates and the expectation. It's kind of this nice little curve that the market is pricing in up to 10 interest rate hikes and ultimately getting to 3%. We currently sit at 0.75%. And given how big the sell-off is, I guess just like, how much weight do you actually put into kind of 10 or so interest rate hikes and getting to a 3% interest rate versus there's no way they get there and the Fed will have to capitulate on this plan, well in advance?
Yeah, so it would be my pretty high conviction based case that they are not going to get to 10 total rate hikes in 2022, and that the market is going to force them to slow down before they get there. And, part of the reason why I'm, I would say bullish, how would I frame this? Bullish from here through the rest of the year, over a sort of, 7-month time frame, is that when the market realizes that the Fed is not going to hike that many times, then the expectation of tightening will be greater than the amount of tightening that actually comes to fruition, and that will provide a backdrop for asset prices to have a relief rally as less tightening than jawboned comes to fruition, if that makes sense.
It makes complete sense. And I'm of the same belief. I may take it one step further. I can't remember if I said it was like a 70% confidence level that I actually think the Fed may have to cut interest rates at least one time this year. So the thought process would be, as they continue to hike interest rates, they enter that environment that you just described where they got to slow down, or they skip over a couple of times where they thought they were going to hike. I even think they may go further where, given that midterm elections are coming, if they hike interest rates enough, they push us into a recession, all of a sudden, the only thing worse than high inflation going into an election is an actual recession. And so do they give us kind of like a gut check? Do they say, hey, you know what, actually, let's cut one time to kind of give some confidence back to the market to try to equalize where we're at? What's the level of maybe confidence or thought process that could occur?
Yeah, so it would not be my base case that they would cut this year. Certainly not out of the realm of possibility. I mean, you can just see it in prices today and over. It's worth mentioning that this monthly went out May 1st. So this is kind of 9 days old, and everything's gotten much worse in the last 9 days. So like every single one of these charts looks meaningfully more pukey right this second than it did 9 days ago when this monthly came out. And I think that looking at how much the market is forcing the Fed's hand right now, I think that they want to hurry up and get back to a quote unquote neutral rate, to get back to 2%, but they just hiked 50 bips. I think it's highly likely that they hike another 50 bips in June, and then another 50 bips probably another 50 bips in July. And that'll get us to nearly 2% interest rates, right around 2%. And then there's no meeting in August, but there's the Jackson Hole, very large kind of meeting of the minds every year at Jackson Hole with the Fed. That's at the end of August. And then you have a Fed meeting in the middle of September. And I think by the time you get to Jackson Hole or that Fed meeting in September, you could have a setup where asset prices have, continued to fall a lot. And then I think this is going to be all eyes on leading inflation and economic growth indicators. And it's my, I would say medium conviction base case that all of those are going to show month over month declines, basically starting last month. And then we've had peak inflation, and you're going to see those leading indicators, continue to roll over the coming months. And that's going to give the cover that the Fed needs under their mantra of being data dependent. And so by being data dependent, they'll be able to slow tightening and then probably pause tightening. Maybe they go 25 bips in July or in September instead of 50 bips. And then the market will be watching all of that and be sort of centering around this slowdown. And like I said, it's all one trade, and don't fight the Fed. And so a slowdown in tightening relative to expectations, these 10 rate hikes, I think provide the backdrop for relief rally later on this year.
Yeah, it makes complete sense. One of the things that I keep going back to is this idea of if it is all one trade, how much pain will they allow for the average person to suffer? And so recession, I think most people are like, oh, that sounds bad. But obviously when things get overheated, people make really stupid financial decisions. And we've got a chart here that you included in the update that Bloomberg had, where they had a model 60-40 portfolio. And they're showing that it is having its worst year since 2008. And so if already in 2022, the 60-40 portfolio, which is kind of the standard in, kind of the retail asset management game, if that's having its worst year and they continue to hike, it seems like this could get really nasty in that 60-40 portfolio. Is there any framework or thought process that you use to kind of say, like, here's the max pain that is allowed? Or is it literally there is no kind of lower bound and hey, they're going to keep hiking the interest rates so they get inflation, and if you're the sucker taking it on the chin, then you're the sucker?
Yeah. So a couple of things I'll say on that. One, that chart you just showed looks way worse 9 days later. So I'd say that's that's the first thing I would say. On a recession, I think it remains to be seen whether or not the Fed can engineer like a kiss to zero GDP growth and then kind of back higher, a quote unquote soft landing, or whether or not they're just going to hammer this thing straight into a recession. I think when you look at the totality of the way the Fed has acted over the last couple decades, it is not my base case that they would, when you look at like what they have done, what they can do, and what they're incentivized to do, hammering this thing straight into a recession does not make a ton of sense to me. It makes more sense to me that they would try and maximum jawbone right now, which they're doing. You got Dudley writing an op-ed saying we got to crash stocks. A lot of these other Fed officials are, when they talk, a lot of real hawkish jawboning. And that they're really trying to jawbone inflation down over the coming months, and economic growth is going to go with it. And if they can get that into an okay spot, then they can just kind of back off, and maybe you can kind of get this like kiss of a zero GDP growth and then back up and then resuming, so like prior to COVID, we were in the longest, slowest economic expansion in U.S. history with pretty low unemployment and very low inflation. The Fed was barely able to kind of keep its 2% inflation target. but that was a tremendous time to own any kind of assets. If you owned any sort of assets over that period of time, you did really well. And the Fed's constituents are boomers, and boomers own all the assets. So it's a very good time to be a boomer. And I think I don't see any reason why they wouldn't want to recreate that now, which is part of the reason why I think it's my base case that they would just try and manage through this sort of soft landing. And then you go on pause with the Fed funds at, somewhere around 2%, and you get inflation back down to, 2.5, maybe 3%. And that's a fine outcome. And, in terms of things that I would be watching, that the Fed might be watching, I know they're paying a lot of attention to financial conditions, which, like I said, can tighten through the decline of stock and bond prices. The Fed gets very nervous with short-term funding markets, financial markets globally. This is a debt-based financial system globally, ton of debt. It all runs by borrowing lots of money. And there's the short-term funding market where, many billions of dollars are borrowed overnight in between banks and financial institutions, and from the Fed and to the Fed and back and forth. All of that plumbing has to work seamlessly all of the time. And when there's even a small hiccup in that short-term funding market, those hiccups metastasize into everything else very quickly. The Fed is terrified of that. And that is the sort of thing that they will not let get out of hand for long at all before they step in, because this whole thing's a big rickety piece of shit. And when the short-term funding markets start to show stress, that is a sign that the Jenga tower is looking quite wobbly. And so that would be something to pay attention to. And then I think I just look at the MOVE index, which is the MOVE index is like the VIX for bonds. It's like the volatility of yields, basically. And the MOVE index is in a tough spot right now. It is very elevated. And if that were to see a spike, that's the type of thing that sort of precedes the type of hiccup in short-term funding markets. So those are the sorts of things that are sort of the flashing red alarm bell going off type of stuff. And they are looking on the verge of having problems right now. And like, look, you may fast forward a couple of weeks and all that looks way, way worse. And, we may be done way sooner than I would think, but it's the kind of thing worth paying attention to every day.
So let's take your base case of kind of we end up somewhere around 2%, and then they kind of chill out a little bit. Bitcoin today is trading somewhere around $32,500, $33,000. And I'll use Bitcoin as a proxy for the crypto market overall. When you think about that base case, how do you balance in your head macro impact on crypto prices with what I'll call more of the like micro market structure of crypto? And so using Bitcoin as the example, we know realized price is somewhere $24,000, $25,000. We know that, 65% of Bitcoin hasn't moved in a year, but we also know that the Fed is, basically trying to nuke asset prices. And so like when you're evaluating what could happen, and it's all probabilistic, but like how much emphasis do you put on macro and Fed activity versus, Bitcoin or crypto people are crazy, they're holding these assets, there is no price at which they'll sell, and like there's some safety there? Like, how do you balance those?
Yeah, we definitely look at both in our investment process, and we look at I'd say the crypto micro market structure from a pretty quantitative perspective, and then we have a more kind of qualitative overlay that incorporates both kind of crypto qualitative fundamental news flow type of stuff, and also macro. And macro is major league in the driver's seat right now. I think the first chart you put up about the how tightly Bitcoin's correlated to the NASDAQ proves that point. I don't see a reason why over the immediate term that Bitcoin would, or crypto broadly, would be able to decouple from macro. It's all one trade. That's as locked in now as it ever has been. I do think that when Bitcoin's 50% off of its recent high, like it is right now, I do think you get into a situation where, the supply demand imbalance in terms of the people, the market participants that are willing to sell Bitcoin more than 50% off of the top relative to the market participants that are willing to dollar cost average buying Bitcoin 50+% off of the top, that imbalance does start to swing, much more heavily in favor of the buyers. And we're very clearly in that zone right now. We're coming up on a spot that's pretty important. We're a couple $1,000s below current prices, the late July 2021 lows that Bitcoin held. If we were to lose that level, which would happen with a backdrop of even more stress in traditional markets than we're seeing right now, some of those stress points that I was just talking about a second ago, I think it could get pretty gappy to the downside if we lose that 29, 30K level. And you could see a lot of spot Bitcoin change hands down there in the kind of mid 20s range for Bitcoin. And that's usually the type of capitulatory price action that marks cyclical bottoms. And, I think there's a decent chance we could see that in, coming up. But those would be, generational buying opportunities. That's like, you're buying for your kids' at $24,000 Bitcoin. And so one of the things that makes this setup different than prior setups is that the cat is out of the bag in terms of what asset class you want to own when the Fed eventually slows down on tightening or goes on pause, and then eventually sort of goes back to a looser monetary policy. That's very different than the 18, 19 bear market, when the vast majority of institutional capital wasn't involved in this at all and didn't have any idea how to think about this asset class. I think that makes for just a very different backdrop. The cat's out of the bag. Like, when the Fed goes on pause, there's nothing on planet Earth that's going to move faster off of the bottom than crypto. I'm highly convicted of that. I think a lot of smart money is highly convicted of that. And this tightening phase that the Fed is in, everybody knows that this is a pit stop until you go on pause and then eventually cut rates again. And so all of that combines into like a pretty interesting situation where, stocks are nuking right now, traditional's nuking right now, crypto's nuking right now. But if you're not a forced seller, this is a terrible time to be selling crypto, to be selling Bitcoin. And if you got cash on the sidelines, you're setting up for like an incredible buying opportunity.
So it's fascinating to kind of hear you talk through this.
Not financial advice.
Of course, not financial advice. Nothing on this show is financial advice. Entertainment purposes only. One of the things that ends up being really interesting is if we go back to 2018 and we look, Bitcoin had peaked in 2017 at $20,000. It had drawn down and it was sitting somewhere around $6,000 or so, $5,000. So it had drawn down like 75%. And I think a lot of people were like, oh, it's down 75%. Like, this is the bottom, quote unquote. And they're getting very excited. Obviously, it puked all the way down and eventually hit, I think it was like 3,200, give or take. And it was very much a puke, right? There was kind of this grind down to 75% drawdown, and then you hit that 3,200. And then pretty much from there, once you hit the bottom, grind it up, and everyone knows kind of what happened from there. Is your expectation from a market standpoint that these types of markets will just grind down, eventually hit some bottom and then recover? Or do you think that there is kind of that puking or that final capitulation that occurs that could send prices down, I don't know, maybe a couple $1,000s in one kind of rapid move? Or like, how do you think about just the expectation you would have for what will eventually be the bottom, whether it's now or some lower price.
Yeah. Well, it's for a bunch of different reasons. The setup here is not comparable to November 2018. It's just not the same for a bunch of different reasons. It's a much bigger asset class. It's a much more institutionalized asset class. That was a almost entirely retail driven market. And you had this hangover from 2017 that was much more excessive than the price action that we had in 2021, in 2020 and 2021, especially in Bitcoin, I would say. And so I struggle to compare the two. I struggle to compare the 6K level that we bounced off of in 2018 a bunch of times before we broke in November and got cut in half. I don't think that's comparable to, like, say, this 29K level from July 2021. That's not to say that I don't think we can lose 29K this time around, because if the stress gets bad enough in traditional, which there's quite a decent chance that it could, we could lose that 29K level. But it could, like I said, it could get pretty pukey. But I think the ability and the willingness for the market to look through the short-term volatility and that short-term pukiness to look at this asset class broadly and Bitcoin specifically and say, this stuff is all much higher a few years from now, just makes now incomparable to like that 2018 timeframe when, like, people just thought all this stuff could go away after that November 2018 price crash. And one of the things that I remind people of a lot, because in this monthly market update that we've been looking at charts in, I have these monthly highlights, just like a bullet point of, like, my subjective view on the most impactful sort of news announcements over the course of the month. And one of the things that I track pretty closely that's just been astonishing is the amount of venture capital coming into the space and the magnitude, the breadth and depth of the capital raises for projects, and then the amount of VC fundraises. So, like, the funds themselves and then the projects that they've been funding, and you put that together, and just like the aggregate amount of capital, permanent capital that's coming into this space is stunning and completely different. And you're talking about hundreds of projects that already have years of runway today, and then VCs with billions and billions of dry powder that they're sitting on today, if not another dollar is raised into crypto VC. And all of that is going to be deployed over the course of this year and next year and the year after that, if not another dollar of permanent capital comes into this space. And it is that capital that will fund the projects and the innovation that will drive additional adoption, that will, put a bottom in for this market and cause all of this to head higher than it ever has been before. And, like, I'm about as highly convicted on that as I can be on anything.
Yeah, I tend to think that everything involved with the fear of the market is very, very short term. We could be talking weeks, right? I don't think that this continues for 6 months and then we get a bottom or anything like that. Like, it feels maybe we're not quite there yet, but definitely there's way more fear than usual, and so that usually tends to be a pretty good indicator. Talk to me about there's two different elements of the market I see people talking about on the internet a lot. I don't know if you necessarily have unique thoughts here, but just I think people hearing kind of how you view them given the investment strategy that you all have at Ikigai. The first is Michael Saylor. He's accumulated a ton of Bitcoin. He recently put what I would consider a pretty small position, it seems like, where he borrowed against some Bitcoin and bought extra. Do you worry at all that there's like a price where Bitcoin could get so low that he would become a forced seller or accelerate downward price pressure? Or like like what's kind of the risk maybe of somebody like a Michael Saylor and MicroStrategy to a market from if you're just looking at price, right? Obviously,
Yeah.
there's a ton of benefit. Like, how do you just evaluate what that impact would be on the market or what you're paying attention to there?
Yeah. So a couple things I'll say on Saylor. One, after their latest earnings call, it was like widely misquoted or taken out of context of what their situation is in terms of being like liquidated or that sort of thing. They could have a margin call on that separate. I think they bought $200 million worth of Bitcoin in a separate entity that has some covenants around it. They could get margin called on that, but they're also in the position to contribute more Bitcoin from their balance sheet into that entity to shore up the collateral requirements for that. And so it's not a liquidation or like a, death knell margin call type of situation like people were talking about. So I would say that. And then I would also just say, though, that like crypto has a tendency to like it has fat tails from like a statistical probability perspective. And crypto just has this tendency to do things that you thought were incredibly unlikely or virtually impossible. And to have those types of events come to fruition at a higher likelihood than you would assume. And that's what I mean by like fat tails relative to like a normal distribution type of deal. And so I would never say never with something like that, but I think it's a very low probability. I would also think that if Saylor ever got into some kind of tough position where I don't even know what that would look like, where he contributed Bitcoin from the balance sheet into this covenant restricted side vehicle that he has that he borrowed, like that whole situation. There's just a tremendous amount of like extremely well capitalized Bitcoin bulls that, like, in the same way that El Salvador's Bitcoin bonds before we had stress in the bond market and they put the volcano bonds on hold, like that. Those El Salvador Bitcoin bonds were like oversubscribed. And my guess was they were oversubscribed, at least in part, by people that are just very bullish Bitcoin and see the developments happening in El Salvador as being good for Bitcoin broadly and willing to support that. I would guess you would have the same type of support available to Saylor if he were to get into a tight spot like that. So
yeah, I think that's actually a really interesting way to look at it, as to there's just certain things that happen in the market, regardless of the economic kind of underwriting of it. There's people who say this is good for Bitcoin and therefore I will participate, whether it's bonds, et cetera. And then if you actually can overlay, it is a good economic decision based on their underwriting, then there's just even more folks who are willing to kind of step in. Does that make sense? Another group or person that seems to be in a similar but different situation is the Luna Foundation, and this idea of trying to peg UST to $1. How do you think about the similarities or the differences with Saylor, but also kind of the potential risks or things that you're looking at for market and the price of Bitcoin as that kind of unfolds in that situation?
I think they are somewhat comparable, and I would broadly ascribe more risk to the Luna situation than I would to Saylor situation. I mean, you're dealing with a sort of algorithmically controlled, but also backed stable coin. It's pretty incomparable relative to any other stable coin that's been in existence in crypto. There is risk present there. But I still think it's like, relatively small. And they just had an announcement that came out overnight about some stability mechanisms that they're putting in place. There are several stunningly well capitalized entities that are in support of this Luna situation that are the types of entities that have a very outsized influence on just what the crypto market is going to do broadly. Like, it's like you put Jump and 3AC into a room and you go, this room controls how much of what happens in crypto broadly. And it's like a real amount of what happens in crypto is a function of like what Jump and 3AC decide is going to happen. And these guys look like they're in position to be very supportive of this thing, but it is, like I said, a newfangled type of deal. And so there's risk present, and I would say a higher degree of risk present than the Sailor situation, but it's not my base case that you're going to see some kind of blow up there.
Yeah, I tend to think that that's probably a very fair analysis of like there is more risk because of the peg, et cetera. Unlikely that there's some massive blow up. But I think your point about why there's a lack of blow up is mispriced by people in the market, right? Seeing a Jump, seeing a 3AC, and some of it may just be like folks in the Bitcoin community may not understand or recognize the size, the enthusiasm, the level of participation from those groups in a lot of this stuff. And then some of it is just almost feels like there's people in various communities that are just cheering for destruction of those types of things, right? Like kind of like I get to say I told you so, which is like a very kind of weird, exotic development of rather than like the open-mindedness.
I call it Big Short syndrome.
Okay, explain.
Yeah, like it's Big Short syndrome. It's like people are begging for these enormous blowups because the people that shorted the subprime crisis in 2008 were like heralded as such heroes. Like Michael Burry's like a great example of this, right? And Michael Burry like hung on to this Tesla short for however long, and I mean I think got like blown out of the water on it basically before it ended up working, which is there's a lot of irony to that. But people are like always looking to like be the like sky is falling bear and then like nail that trade, and then they get to like parade that they like nailed some Big Short type of thing, and like that mentality has sent a ton of people to the poorhouse over the last decade or so, or, looking back over the history of financial markets over many decades, and being overly bullish and highly levered sends people to the poorhouse as well too. Which I guess like, what is it like, whatever, bulls and bears both get to eat, but pigs get slaughtered or something like that. So, yeah.
Yeah. And I guess part of this also is there's a bunch of folks who, outside of the Bitcoin community, today we saw Noel Rubini, I guess, is working on like a tokenized dollar cryptocurrency. There's plenty of other folks who are still skeptic, bearish, flat out, maybe even shorting the market. But it does feel like you're starting to get some specialization in crypto. So there's some people who are Bitcoin. There are some people who are part of Ethereum or the smart contract platforms or NFTs, et cetera. 2016, 17, maybe even in 2018, like you could just be, I'm a crypto investor, and you could pretty much touch or understand most of the market. I do think that bifurcation is changing a little bit. But with that comes this feeling of like a zero-sum game where people say like, oh, NFTs are going to work, but X is not going to work, or, Ethereum's going to work, Bitcoin won't work, or vice versa, et cetera. Like, how do you think about specialization in the market today? And then also, is it a positive sum game where like all of this could work or some of it could not work and some of it does work, but like they're not necessarily tied together as much as they used to be?
Yeah. So, I mean, tribalism's been around for a long time in crypto, forever, right? It doesn't strike me that tribalism is any stronger today than it has been. It's just always been strong. And I think that even within the tribalism, there is a view, I guess like the most extreme examples of tribalism, there isn't this view that like, hey, we can all win here. But I think once you get outside of the like tail of like the extreme tribalism, that even Bitcoin fans and ETH fans and Solana fans and NFT fans, the large majority of those, even if they have their favorites, can still look at the thing and go, this whole pie has a lot more room to grow. And there are strong structural inflows into this asset class and this technology, directional flows, to my point earlier about the amount of venture capital coming into this space. There's structural inflows into crypto that, you have outflows and people are worried about the Fed in the short term, but over any kind of medium, longer term horizon, that's up and to the right. Super highly convicted on that. And then also, like, there's no other asset. There's nothing that derives more of its value from network effect than crypto. It's an even more pure expression of network effect than like through value creation than even a social media platform. And so to that end, it's like if more people are coming to crypto, even if you're a Bitcoin fan and more people are coming to ETH, or you're a Solana fan and more people are coming to like ETH NFTs, that broad pie growing adds to the value of the asset class as a whole, because all of it is so much driven, the value of all of it is so much driven by network effect. And so there's plenty of room for like everybody to win from that type of setup.
Yeah, I tend to agree that is true. One of the most popular questions I get right now is how people can make money in a recession. As you think about asset prices falling, the Fed stepping in with higher and higher interest rate increases, how do you think about positioning a portfolio? Is there psychological things that you look at? Are there frameworks you use? Or are there tactical things that you're employing in terms of actually being able to make money during a recessionary period?
Yeah. So I guess recession is an economic term. I think recession versus like market, strong market, like asset price decline, I think of those things as two different things, because we could end up in a recession in like Q1 of 2023 or Q2 of 2023. And like the NASDAQ could be way, way higher off of its lows when that recession hits, because asset prices and economic growth are like two separate things. And asset prices are so strongly a function of what the Fed is doing. And by the time the Fed goes on pause or the Fed slows tightening, which will absolutely rip all asset prices with crypto leading the way, that could still be sort of like potentially too late to like keep us from dipping into a shallow inflation or a shallow recession rather. So I would, kind of delineate between those two things. In terms of positioning, it just kind of depends on what your outlook or like what your, I guess, goal for your, everybody's in different positions with their, I think there's a lot of just like kind of everyday retail folks that are watching this, have some cash on the sidelines. Now's not a good time to be using leverage at all. Knife catching is not a good idea for retail traders. It's like never a good idea. If you've got cash on the sidelines, when crypto is more than 50% off of its top, starting to dollar cost average into, buying more Bitcoin, buying more ETH, historically, that has worked out incredibly well. I think that there's no reason to think it's not going to work really well right now. And, I think the fundamentals of this space are unequivocally getting stronger. And that is not being reflected in price action right now. But that is a temporary disconnection as monetary policy from central banks is in the driver's seat. But that will pass, and it might pass sooner rather than later. But that will pass. and fundamentals will move back into the driver's seat. And so there's nothing to be worried about from a longer term perspective about the viability of this asset class. Crypto broadly is going to continue to eat the world. And we will get, with just a small amount of hindsight, we'll look back on this pullback like we look back on a bunch of other pullbacks that, people barely remember. But you just want to make sure that you're in a position to keep playing the game. You got to be in a position to be able to continue to play the game, because the asset class broadly is going to create trillions of dollars of value over the course of, this decade and the next, and probably the one after that.
That makes sense to me. The number one question I'm getting from all of the live viewers is they want to hear your thought process behind selling Bitcoin for other assets and some of the more tactical stuff you're doing. I don't know what you're allowed to say and not say from like a regulatory standpoint, but anything that you can provide in terms of some insight there, I think people are super excited to hear from you.
Yeah. So I think the one thing I'll say is, so I went on. We actually talked about you, Pop. I went on Yano's podcast like 2 weeks ago, the Empire podcast, and we were talking about all the way back in September 2018 when Yano was like doing the camera and the microphone setup for the Pomp podcast back then.
Correct.
Yeah. So we reminisced on that and how far those guys have come. But on that podcast, I talked about this ETH merge, this kind of ETH merge catalyst, which in my view is the most significant, most telegraphed catalyst in the history of crypto. And I think which is like a pretty hyperbolic thing to say, but I think if you look back on the history of crypto, for something to be a bigger catalyst, a more significant, more telegraphed catalyst than this, it would either have to be something in Bitcoin or something in ETH, because if it was something in any other asset, it just wouldn't have, by definition, wouldn't be as significant as being in those two. And like the halvings in Bitcoin are different because they're programmatic, and they're also just less significant in my view relative to this ETH merge setup, which is ETH going deflationary, ETH turning into a yield generating asset, and ETH moving to ESG friendly. And I think we all know what a behemoth ESG is, and it's a separate conversation about the legitimacy of that movement. But I think we can all agree that it's a big movement and people are focused on ESG type of stuff, and a move from proof of work to proof of stake is a step towards ESG. And it comes at a time when ETH, there's never been more institutional eyeballs on ETH. There's never been a greater willingness and ability of institutional capital to buy ETH in size than there is today. It is not the same as the COVID crash. It's not the same as the COVID crash. ETH would, like, what did ETH get down to on the lows? It was incredible. Did it get down to $200 on the COVID crash lows?
I don't remember the COVID crash lows. I know in the 2018 crash, I think it got down $70, $75. Dude, COVID was what?
Holy cow. At the absolute low, ETH got down to $90 on the COVID crash. $90. The market cap was like, when ETH was $90, the market cap was like probably, I don't know, $10 billion or something crazy like that, right? Like incredibly low. Like you can't, institutional capital could not buy ETH in the spring of 2020. It was just too small. It was too unproven. It was too volatile. And the thesis was not well understood for ETH at that period of time. And all of that has changed a lot since then. Okay. Yeah. So on the lows, Ethereum's market cap got down to $13 billion. Institutional capital is not buying a $13 billion asset. They cannot. It's not possible for them. Whereas now, ETH is a $285 billion asset. Institutional capital can buy a $285 billion asset. And so I think all of that combines together with a setup for, and look, there is risk that inflation remains stubbornly high. And if we go back to that orange and black chart that we just looked at, 10 rate hikes in 2022, if we can't get these leading economic growth and inflation indicators to roll over, the Fed, I think, is just going to have to keep tightening. And if that ends up being the case, you don't want to be long any of this stuff because prices are just going to keep going down, and you increase the likelihood of like a really nasty outcome that forces things to go on pause and pushes us into a recession and a full-blown, nasty market crash in all asset prices. But that's not my base case. But there is a risk that inflation could remain stubbornly high. Ukraine definitely presents risk there. The China lockdowns definitely present risk there. Although the people that I talk to that understand the Chinese economy the best, there is not agreement on whether or not China lockdowns are inflationary or deflationary for like U.S. inflation measurements. There's just not agreement on that. So I think it remains to be seen on that. But there's risk to my view for sure. But my base case is that inflation and economic growth indicators are going to roll over in the coming months, and then it sets up for the Fed to decelerate tightening relative to expectations, either at Jackson Hole or at the mid-September FOMC meeting, which lines up really well with when the ETH merge is going to be put on. And you put those two things together, and it has a potential for incredibly explosive price action in crypto broadly, but ETH in particular. Dude, if they go on pause like plus or minus a month of the merge, ETH is going to teleport. It is going to teleport. And I think it looks like ETH is in heavy accumulation mode right now. And you're going to get to like the depths of the summer when there's no eyeballs on this market, when trading volumes are at the absolute lowest, and people are getting all bared up, and all the spot ETH is going to be held by people that aren't in the mood to sell it anywhere close to the bottom. And you can just, and I remind people, like on the late July 2021 bottom, which didn't really have much of a particular catalyst to it. I mean, you could look at the B Word conference with Elon and Jack Dorsey. That did kind of put the bottom in. ETH went up 120% in a straight freaking line off of the bottom. And that was nowhere near as bullish of a backdrop as what we potentially have with ETH merge lining up with the Fed decelerating tightening. And so that's one of the most attractive setups I've seen. You're going to have every traditional investment fund on the planet that's going to be trying to make up their entire year, which has been going real shitty for almost all of them up until this point. And like, if you're trying to find the fastest horse, like to borrow Paul Tudor Jones moniker, BTC will move real well off the bottom as well too. I think ETH could just like,
So did you basically in some way say, hey, look, Bitcoin is what it's been, there's market structure, et cetera. ETH, for the reasons you just laid out, you just think has more upside to it. And so you guys basically shifted. And then did you also go look at other assets as well? Or like, how did you think about outside of the Bitcoin ETH, kind of blue chips, if you will? Did you guys go take a look at like, oh, if everything goes up, the things that are the smallest cap will go up more? Or how would you, I guess, analyze that part?
Yeah, we don't really play that game, so to speak. And I think you got to be cautious with liquidity. And as you move outside of BTC and ETH, very quickly, that stuff, when the market's pulling back a lot, and when you're in a, when traditional looks like shit, like it does right now, that stuff goes no bid to a degree that like, that stuff goes down 50% and then it goes down another 50%, and then it might go down another 50%. Right. And, so I think you got to be real careful moving down market cap. The two things I'll say is on that one, we've been spending a ton of time in metaverse and Bitcoin gaming, play to earn, in-game assets. We've been spending a ton of time on that and are captivated by that space. It's very early. It those assets, the way the in-game economies work right now, it's like, Pomp, you and I talked about this before. It's like I used to say, like, Bitcoin's the most reflexive asset on the planet. Well, like, play to earn is like definitely more reflexive than Bitcoin. Like, it's inherent in the nature of the way those in-game economies work, that it's just very, very reflexive. So to the downside, it just gets like real nasty in a hurry. So that's not where I think we're in the mood to deploy capital in anticipation of a bottom. But then all the stuff's it's all gonna probably run harder than everything else off the bottom as well too. But you wanna see which of these projects sort of make it out of some really nasty price action and actually can retain users and grow users and compel people to get back into these in-game economies. So we're paying a lot of attention to the innovation that's happening in metaverse and play to earn, mostly from the sidelines in terms of capital deployment, but we're paying a lot of attention to it. And then I think the other thing you would look at is, like, if ETH runs hard, what happens with the rest of the layer ones? What happens with Solana, Luna, Avalanche, Cosmos, Dot, Near? Like, what happens with all of these? And I think it remains to be seen. I think historically, you could see ETH run hard and then have some kind of rotation into other layer ones. The exact timing of that is, like, definitely difficult to say. Trying to time that is, like, not really a game that I would suggest most people try and play. But ETH's market cap is so like I'll give you like an example, right? Like, so ETH's market cap is, let's call it 300 billion right now. So let's say it doubles from here. That would be like 5,000 ETH, a little less, and that would be like $600 billion market cap. And then let's look at like Solana, for example. So Solana has a $23 billion market cap. So if ETH doubles to a $600 billion market cap and Solana also doubles, then ETH would be 600 billion and Solana would be 46 billion market cap. And then like Solana relative to ETH, that would be flat over that period of time, right? Because like they both doubled, right? And I think at some point the market looks at that relative value spread and they go, okay, ETH is $600 billion, Solana's, $46 billion, whatever, that's 6-7% relative market cap. That spread's too wide, and it should be something closer to 10% or 15% or 20% of ETH's market cap. I think there's a potential for that type of relative value trade to emerge, and the timing of that, remains to be seen. And like I said, that's a pretty tricky game to play. So
yeah, it feels like there's just so much to underwrite as you expand the kind of investable universe. And I think this kind of idea of a market structure, and it brings us kind of full circle in this conversation to, like, it may all be one trade, right? In terms of it seems like crypto goes down together, it goes up together, but you have to start to underwrite risk and reward. And how do you do that is pretty difficult. Before I let you go, I have two questions. One, I think that you were in LA, and I think you've moved now to Texas. What's the geography arbitrage or whatever that kind of thought process there? I'm sad you didn't move to Miami, but I understand. I think you're from Texas. And then also one of our sponsors is 8 Sleep. What's the sleep schedule looking like these days now that you're back in Texas, even though the market is literally, as we're talking, in a free fall, and we're just watching everything bleed everywhere.
Yeah, so did move full-time to Austin November last year. My girlfriend and I were doing Airbnbs for a while last year in Austin. Bought a house in Austin, here full-time. I'm from College Station, which is like 2 hours north of here. My family's still there. My mom would have killed me if I had moved from California state taxes to a 0 state tax environment and I'd gone to Miami instead of Texas. My mom just would have killed me. Yeah. So, and Austin's great. Love Austin. Enjoying my time down here, enjoying the proper suburb life, like rapidly adapting to the proper suburb life after spending a decade in like Venice and then Manhattan and then Chicago before that. So enjoying my time down here, and then I have an 8 sleep and love it, and pretty focused on sleep. I've got this like a Garmin watch. If you like know this thing, it's got a pretty good sleep tracker on it. I'm pretty good about getting at least 7 to 7.5 hours a night. I need to move my bedtime up a little earlier. I'm doing about 12:30 to 8:30 right now. I need to get that to like 11 to 7 because there's some of the like circadian rhythm type of stuff. Like I should be, but it's I don't know. I've always been a little bit more of a night owl, but yeah, I'm super focused on sleep, and I think when I skip it, I feel it immediately. And you know, I'm 37 years old. I'm not getting any younger, so
you look 22. And you're already tracking everything. That's as long as you're tracking everything, right? Like I think that part of it is once you know what works for you. Like everybody's different, but once you know what works for you, like to your point, if you stray from what works, you feel it. Like once you get into it, right? And I'm the same way. It's like if I I need 8 hours, right? So if I don't get 8 hours, I'm like, dude, whew. You just know, like I'm a little bit more irritable. I'm a little bit sluggish, like all these things. And so it's just like a daily reminder, like, hey, get your ass to sleep. Stop, wasting time, all the stuff. So makes sense. Where can we send people to find you on the internet if people are not already following you?
Yeah, Twitter's great. Travis_Kling on Twitter. We write this monthly update letter. So if you go to ikigai.fund is the fund website. And then if you click on content, it kicks you over to a different website, which we just had to do for regulatory reasons. But we have this content depot called Kana and Katana, which is the pin and the sword in Japanese. And that's got all the past market monthly update letters. You can sign up for future ones there. And it also has this like little tab there where you can see just every month, the bulleted monthly highlights from all the past monthly updates. It's probably the best thing to show like crypto skeptics, to give them a sense of like how much has happened in this space over the last like 2 years or whatever. When you look at it all in one place, we've covered a stunning amount of ground since the first time you and I got on a podcast in September 2018. I mean, even since we did the COVID one in May of 2020, dude, we've covered a lot of ground. And all this Fed tightening stuff, all this stuff is a hiccup, dude. It's like all this too shall pass, and the outlook for this space broadly has never been brighter. So everybody should be excited.
Yeah, I tend to think that is a great way to view the market. Bleeding would stop. That'd be nice. But other than that, my friend, I appreciate you coming on. I think people really enjoyed this, and we'll definitely have to do it again in the future. So thanks so much.
Always a pleasure, man.
All right. Talk soon.